Positive day, everyone. My name is May Reyes of Reyes Group Australia Accounting and Taxation. I'm a qualified accountant and a licensed tax practitioner. On today's topic, we're going to discuss to you how dividend works in perspective of a business owner receiving it from his or her own company. And the bonus part, what is the effect of its borrowing capacity? So let's start. So this is a typical company's income statement. And in this scenario, this is way back financial year 2016. So I'm pretty much have, some of you already have a better grip and understanding how the profit and loss statement works. But this is how it is. So sales, 100,000. Expenses, 50,000. Taxable income becomes 50,000. Less the tax. How much is the tax? 15,000. And how we compute it? 50,000 multiplied by 30%. And the profit after tax is 35,000. I would really like you to look at this figure further. And remember this, taxable income, 50,000. Tax, 15,000. Profit after tax, 35,000. My questions to you, how much money is sitting in the bank account? You got it right, 35,000. And how much money does the company pay to the tax office? There it is, 15,000. Again, remember these three figures. Always remember, your company is a separate entity from you. Because most of the people will say, hey May, I would like to get the money from my company's bank account. I'm the owner anyway, and I would like to take it. No, you cannot just do just like that, withdrawing money from your company. Remember, a company is a separate entity from you. It's an artificial being that you created. Hence the reasons why your company has its own tax file number and has its own ABN number separate from you. So let's look at this typical scenario. This is you and this is your company. And as a director of your company, you decided to have a wages of 40,000 from your company. Okay? So, how much money is sitting in the bank account? 35,000. This is what most people got confused. Hey, the 35,000, I would like to have that as an income. So my income is now 75,000. Hang on, that's wrong. I'll show that to you in further details. So this is you, the director of the company. So this is your wages, and we all agreed that you will be given a wages by the company of 40,000. And by doing so, the company is withholding taxes from you because you're the employee of your own company. So there's a withholding tax. In this scenario, there's a withholding tax of 4,367. And you, as the director of the company, would also like to take all the money sitting in the bank account as part part of your dividends. Remember, there is a 35,000 money sitting in your company's bank account. That's the one. But how much are we going to add as part of your income? Not the 35,000, it is the 50,000. In the terms of accounting, we called it gross it up. And that's create confusion to a typical lay person. But to make it easy for you to understand, I would like you to go back again to the profit and loss statements. Remember those three figures that I would like you to remember? The taxable income, the tax, and the profit after tax. So, the one that you need to add up is not the 35,000, it's 50,000. That is the taxable income of the company back in financial year 2016. And as what for us to avoid double taxation, remember that 50,000, it already paid taxes. So here we go. The taxes are in here. We could actually take it back. And this will now gonna be the situation. The total taxable income that you will have now is 90,000. And that is 40,000 plus the 50,000. And how much is the total that you paid to the tax office? This is your withholding tax, 4,367 by having a wages of 40,000. Remember, you would like to get the dividends, and that dividends already paid tax, which is the 15,000. That is what other terminologies in accounting called franking credits. So this is the total amount of taxes that you paid. Okay, and we all agreed and set with that figure. So the new income means new tax rate. We all knew this is a progressive income tax. So the higher your income, the higher your tax. So if we're going to compute, because your now new income is 90,000, you are now subject to pay a tax of 21,517. In these scenarios, there is a difference on tax, and that is 21,517 less the tax that you paid, which is 19,367. You still need to pay the difference of 2,150. As you can see in these scenarios, the situations of the director of the company, it's not advisable for him to get that full amount of dividends in his company for the period of that financial year 2016, because this is what's gonna happen to him. He will pay more tax. As an accountant, we help our client strategize of when it is advisable for them to get the dividends of their own company, so that this will be avoided. The director doesn't need to pay additional 2,150. But then again, remember on the first slides, what will be the effect of the dividends in a borrowing capacity? It will be good, because your income will now increase from 40,000 to now 90,000. I hope in this simple scenario, I try to make it as simple as possible to a layman's person to understand the complex part of the accounting side and how the dividends works. Again, this is May Reyes of Reyes Group Australia, Accounting and Taxations. We love numbers, so you don't have to. Thank you so much for your time and have a lovely day. Bye for now.